Welcome to TheoTrade. This is Don Kaufman. Here we are. It is February 18th, 2017, doing the weekend update here. Where to begin on this weekend? Well, first and foremost, S&P's just a stone's throw off all-time highs. Nasdaq all-time highs. Russell all-time highs. I mean, we can look at any number of equities that are also roughly at all-time highs. But with markets ultimately pretty much pegged at all-time highs, what's it doing to volatility? And more importantly, how that might impact some of your trading. So rather than do the usual here, we kind of look back at the past week over here. Listen, this past week is fairly obvious. All-time highs, right? We're actually going to talk a bit about strategizing, number one, in an incredibly low implied volatility marketplace and really how that might impact you if you're either, number one, an investor, okay, maybe a trader, even intraday trading, really how this low implied volatility can impact you. And to start off that conversation, we're going to look at a very extensive chart on the VIX. Now, listen, the VIX is very, very commonplace these days. It's always been known as like the fear indicator, but I want to show you something really interesting about the VIX that I don't think a lot of people necessarily recognize. First and foremost, what are we looking at? Again, it's the VIX. If you have no idea what the VIX is, it happens, okay, to represent the S&P 500 volatility index. Now, what does that really amount to? So what the VIX measures is SPX options. First of all, the SPX only has options on it, right? It measures the SPX options. And specifically, it measures 30-day. It's like an averaging model of 30-day, okay, SPX option implied volatility. So for the most part, what is implied volatility? It's like supply and demand. And I'll give you a quick example, all right? Back over here, this is, one of the highest readings ever recorded in the VIX. Excluding, of course, I only have 20 years of data right now. 1987 would have been quite interesting. But this is the financial crisis. See the VIX up here in the almost 90 level. For the most part, when I say the VIX is supply and demand, if everybody in the world demands options, well, what happens? Price of options goes up, and that's really what the VIX tends to measure. So with knowing all of this and supply and demand, apparently right now, there doesn't seem to be a lot of risk out there because the demand for options is inherently low. So right over here, okay, that closing number is 1149. Now, I've brought up a 20-year chart, but I checked with a couple of statisticians and a few quantitative geeks out there, and what they were telling me is over the last 27 years, so this is actually going all the way back to the, the very early 90s, if you will, back over 27 years. You have to recognize that the VIX has only really closed below its current level, okay, about 10% of occurrences. So the way to, I just kind of think about this is like, all right, so when all the closes of the VIX, only 10% of those occurrences have actually been lower than the current volatility. And another way of looking at this, and this is the part that really gets me, that means the world right now, 30 days out, okay, because that's what the VIX is measuring, it's 30-day implied volatility, but the world right now, that means would be 90% more predictable than any other time in the last 27 years. Does that seem right to you? And of course, everybody's, no. There's a new administration, there's tweeters everywhere. Yeah, that's my new name for Twitter, right? So we're one tweet away from being, up or down 5 or 10% on the S&P 500. And yet the volatility, okay, ultimately is dead out there. Or is it? So think about that. Is the world really 90% more predictable? Because if it isn't, is the VIX really wrong? And the answer is, well, not exactly. And this is where the conversation is going to turn into more strategy, okay? To look at this, we're going to go over to what's called Skew. Now, I'm going to tighten up Skew because not everybody is necessarily familiar with skew over here. So I'm going to go down to one of my styles, okay, and look at skew. Now, what skew happens to be in the marketplace, it's measuring option sensitivity, okay, the puts versus the calls. So in a moment, we're actually going to go look at an option chain and look at skew. But here happens to be a 10-year daily of skew. Now, skew is only calculated, there's an actual symbol, SKEW. Skew is only calculated once a day at the end of the trading day. Skew, it's the CBOE skew index. It's just measuring the SPX out of the money puts versus out of the money calls. Okay. And it actually measures the implied volatility of one versus the other. Again, we'll get to why is this so important here momentarily, but you can go back and you take a look at skew, and we'll just go like 10-year, for instance, monthly on here, make it very, very easy. And you can see skew right now, it's for the most part the highest level it's been recorded at, okay, since the skew was starting to be measured. And the reason I'm using a 10-year monthly, skew doesn't even go back, okay, before 2011. They didn't calculate it back then. It's still relatively new. Now, let me show you what this means and why it's so important. Because at this point, you're like, yeah, skew, it's really high. And the VIX is really, really low. So what is the skew actually looking at? Well, for this, okay, I'm going to go to the spiders. Yes, I could go to the SPX, but I think the spiders will make it a lot easier. And we're just going to go look at some options that are right around a month in time, right? 32 days. Doesn't matter if you look at weeklies or not. Weeklies are A-okay in my book. But what I want to show you that exists in these option chains, okay? And this, again, this is an option chain approximately 32 days out. You can see the volatility is right what we were just saying it was in the VIX, right? 11.3. But look at the puts, and everything on this right-hand side of the screen is the puts. Look at the puts. All right, here's almost a 13 vol, and here's like an 11 vol. But then we then shift to the calls, and you can see there's like an 8 vol. So the skew is measuring the differential of the out-of-the-money puts versus the out-of-the-money calls. Now, again, I'll close that up. All right, now that you kind of know what it is, start looking at different option chains in here. All right, and then more importantly, after we show you in the spiders, let's go to the SPX, the granddaddy of all the option products available to you. And we go to the SPX, and I'm going to open up just a ton of strikes in here. And I want you to see how massive the skew is. So if you will, I'm looking at options right now that are simply 26 days in the future. That's it, 26 days in the future. We're looking right here at a 2105 put. 2105. Do you realize how far out of the money that is? Okay. You know, you're like, 250 points out of the money. It's huge. Okay. 250 points out of the money. And it's trading for about a 21% implied volatility. By the way, I'm going somewhere with this. I just got to explain a little bit about skew, right? Then we go to the out of the money calls. And first of all, there are no calls that are even that far out of the money. But for argument's sake, I want you to look at some of the options that still even trade out here. I mean, look at these things. They're all the way down to like, a 9% implied volatility. For the most part, okay, the out of the money puts are double, okay, and even beyond the implied volatility of the out of the money calls. Now, how does this impact you? Because that's what really matters. Okay, for this, I'm going to go back over to the spiders, because the spiders, it's just a more friendly place to play. You know, when you think about like trading out there, the SPX, I mean, the SPX is like getting into a batting cage for ultimately, a big league pitcher. That ball's going to whip by you at 90 miles an hour, right? The spiders is, it's like slow pitch softball, and that is A-okay for me because, hey, listen, I'd rather have something thrown at me at like 30, 40 miles an hour, not 110 mile an hour fastball. It's pretty much not my thing. But why is this so important? Because right now, if you trade options, the skew is going to impact everything you do. And it's interesting to say this because the implied volatility, the VIX, has really never been lower, but the skew has never, ever been higher. Okay. So what they're saying is this catch-22. Traders are out there buying out of the money puts And very often, to finance those out of the money puts, they're selling calls. That's what's actually causing the skew. But how does this impact you? Number one, with volatility this low, do you really want to sell anything? Right? Do you want to sell stuff with volatility this low? So here we are in the spiders. And again, I could do this in the spiders. I could do it in Apple. I could do it in Facebook and Google. Okay, it doesn't matter. There's going to be skew in pretty much every single product you look at right now. But here in the spiders, just the easiest thing to take a look at. If, for example, you go out and sell a spread, all right? In this case, we're going to sell the 234 and buy the 232 puts. Like, here's a $2 wide spread for a 65-cent credit. You realize this spread right now, and hang on for a minute, for those of you that are a little newer to this, spiders are sitting at 235. This spread, it's only $1 out of the money. That's it. It's only $1 out of the money, and I'm only collecting 65 cents for it. You're like, well, okay, so what's the point over here? It's $1.35 a risk. That's terrible. You're collecting next to nothing to take $1.35 a risk. I mean, 65 cents, it's garbage. So you're not going out there probably and selling out of the money spread. Now, one of the reasons that the spread is not trading, okay, very well for you, one of those reasons happens to be that the put that you're selling is a 10% vol. The put that you're buying happens to be a 10.7. It doesn't sound like a lot, but the skew is going against you. You're selling an option for a 10 vol. You're buying an option for almost an 11 vol. Yeah, I'm just rounding over here, but you don't think that 0.6% makes a big difference, but it's a huge difference. Now, what can you do in a marketplace like this? Well, first of all, if you wanted to be bullish, you can go out there, and I'm going to show you, like, again, an interesting trade. So we're trading pretty much right at 235. So what happens if we bought the 234, okay, and sold the 236? This is like one of my quintessential trades. It's called an in-out spread, okay, in-out spread. So one strike in the money, one strike out of the money. This spread cost you $1.18. Now, the spread is in the money. In the money means what? We're trading at 235.09. The spread's in the money by $1, roughly 10, but I have to pay $1.18 for it. But now let's look at the exact opposite spread. So instead of buying the call spread, let's look at a bearish trade. Okay, and the bearish trade would be buying a what? Be buying a put spread. So let's look at the idea of going out there and buying a vertical on the put side. And I'm just stacking them next to one another. Now these are, for the most part, almost identical spreads. But I want you to see, and I just lock the price down, right? I want you to see the difference. Because they're skew, this call spread right here is trading, okay, for $1.18. The put spread, which is the bearish trade, is trading for 97 cents. Now, what seems more advantageous? Now, listen, I'm not here to tell you, be bullish, be bearish. I don't care. But I am going to tell you this. The call spreads are not trading very well. Like, I'm not going to buy this thing for $1.18. Like, I have to pay extra because they're skew. And you're like, huh? Well, I don't get it. Look, if you're buying right here, these 234s, and let's really clarify here. If you're buying these 234s, you're paying almost a 10 vol. And then you turn around and selling what? You were selling the 236, which ultimately the skew is going against you by about what? About 0.8% the skew is against you. On the flip side over there, okay, if you use the put spread, you're buying the what? You're buying the 236s. They have roughly, okay, a 9.9 vol. Then you're turning around and selling the 234s, which actually have a higher vol. So the skew is going with you, right? You're buying a cheaper implied volatility and selling a more expensive implied volatility. So the very simple beginning to this is, it makes sense right now for people like to want to buy a put spread. You're not going to go out and you're going to sell a put spread because the skew would be against you. You'd be out there and you'd be buying a put spread, okay? Because ultimately, that's where there's value right now. There's value because the skew is going with you. Now, what if you wanted to be bullish? Okay? If you wanted to be bullish, I don't want to get too cute with this, but if you want to be bullish, you could use things like ratio spreads because the skew is, again, in your favor. And you're like, whoa, ratio spread. Oh, that sounds pretty exciting. Let's go even a little further out in time. All right, and these quarterlies over here, listen, there's all kinds of weeklies and there's April options. And again, the skew is kind of with you here. And when you think about, you're like, oh, yeah, I want a ratio spread. You sell one of these, okay? Maybe buy, for instance, two of these. Look at this. The whole trade is done for pretty much even money. This is actually a type of a back spread. And the reason the back spread works, if you're looking at the trade very carefully, I'm going out there again, and I am selling a 238 call. Okay, and I'm selling it for about a 9% vol, and then I'm turning around and buying two times, okay, the 241s. So again, selling one of these monkeys, and for the most part buying two of these. So this one I'm short, this one I'm ultimately long. And again, it's a 1/2. It's a ratio spread. And there's still a valley of death to deal with in this trade. But I'm showing you, if you're going to get bullish, you have to get bullish in very smart ways. You're really limited right now as to what you can do because it's low implied volatility. And I'll come over here and I'm gonna analyze me a trade. And again, you can see this is how you would create a more effective bullish trade. But you got to be careful in here because again, right in there's a little bit of a valley of death. You just exit the trade a couple days early. So it's easy to get bearish, right? You just buy an in the money, what we call an in-out spread. It's kind of easy to be able to get bullish in the case of using something like this ratio spread. But right now, people are going to ask me about calendar spreads. Listen, they're just not pricing very well, nor are many of our butterfly strategies out there. The skew is extremely heavy, and that's what's impacting. It's making it difficult for all of our traders right now, to put together these option strategies, whether it's calls, whether it's puts. That skew is going to impact you. And again, as I said, it doesn't matter really what products you look at, whether it's Netflix or Facebook or Apple, and Tesla's even going to have earnings coming up. All of them are being impacted by skew, and all of us, okay, have to recognize, listen, we're in an incredibly low implied volatility climate. And this is not a smart time to run out there and to want to go into sell options premium. All right. Right now, I'm a net buyer of premium. Sure, I went out and used like a ratio back spread over there. I'm selling one option, but I was selling one option and buying two. I'm still ultimately net long premium in any way, shape, or form. And I want you to think about that until we really start to see some expansion of volatility. Be careful what you do. Okay? Be very reserved with how you allocate capital right now. Don't put a tremendous amount of capital at risk in an incredibly low implied volatility situation. Okay? Because as we start to migrate from this low implied volatility to more extreme levels of volatility, number one, you got to realize we haven't even had any real volatility in years. Sure, August of 2015 and Brexit was exciting for 2 days and the election was exciting for a couple of hours one night. That's been it. I mean, you got to go all the way back into 2011, maybe even 2012 to see some real volatility. And yet most clientele I deal with on a day-to-day basis, they haven't even actually seen what real implied volatility is. Think about that in this coming week. My name is Don Kaufman here at TheoTrade. Join us all throughout the course of this week in the TheoTrade chat room. Have a great weekend, everybody. Bye-bye.